So last time I talked to you about Subpart F income, I was talking to you about an American who's a friend of mine who runs a business overseas, and I promised a two-part segment on that topic. So here it is, part two, stay tuned. Now we're talking about GILTI. Hi there, my name is Javier Correa and I'm a Research and Development Associate here at Nomad Capitalist, where we help 7- and 8-figure entrepreneurs and investors go overseas, optimize their tax, and set up the ideal corporate structures to run their businesses. So last time we spoke, I talked about Subpart F income and about how it is inconvenient, how it's been around since the 1960s, and how globally it essentially targets American individuals and companies that want to defer taxation of either passive income in the form of the personal holding company, or Americans and American entities and individuals who want to shift profits by using either a company offshore to provide services to a related party, or maybe buy goods from a related party and things of that nature. Now, today I want to speak more about the second type of taxation that Americans running corporations overseas need to be concerned about, and that is GILTI. So obviously GILTI is a very funny acronym, and it is easy to remember. However, it's important to note that it stands for Global Intangible Low-Taxed Income tax. That's a bit of a mouthful, so we'll stick with GILTI for now, but I wanted to give you the official name at least once. So the major difference here is that GILTI is very new. So GILTI was included in the US tax legislation as of the Trump tax reforms, and that took place in, I believe it was approved in December 2017, and it took effect in the 2018 tax year. So unlike Subpart F that has been around for at least all of my lifetime and the previous generation, GILTI is something very new that has evolved to a certain extent in its short period of time, and therefore we're continuously monitoring to make sure that any updates are brought to you immediately on this channel. So in addition to being very new, GILTI is also much more aggressive than Subpart F. As discussed before, Subpart F targets specific forms of income that can be included regardless of whether or not the CFC is paying out dividends, but GILTI is a whole other ballpark. So in GILTI, what essentially is the US government looking to do? So unlike Subpart F, GILTI targets the entirety of the income of the CFC. Right? So we're not looking at specific forms of income, but rather we're looking at the CFC's income as a whole, which already starts us off at a disadvantage. Now, in addition to that, what the US government claimed it was trying to do was target income from intangible assets like copyrights and patents being deferred in foreign subsidiaries. Now, the end result that we got was simply a sort of minimum tax on the entire income of the CFC. So in the case of Subpart F, it is relatively easy to avoid if you're running an active business and you're dealing with independent third parties and you're not really engaging in any profit shifting. Whereas in the case of GILTI, really regardless of whether your business is active or not, regardless of whether it is conducting its trade or business in the country of incorporation or not, it will still be subject to GILTI. So what and how do we calculate GILTI essentially? So what GILTI does is the US government takes a look at all the tangible assets in the business, and these are the tangible assets, if I want to be more specific, that are depreciable under Section 167 of the Internal Revenue Code. So I'm talking buildings, factory equipment, tractors, vehicles, if you have vehicles in your business, anything of that nature. It's very industrial, so to speak. So they take a look at all of those tangible assets, they sum up the value of those tangible assets, and the US government has decided that a 10% return on tangible assets is reasonable, but anything beyond that, they will deem it to be income derived from intangible assets, such as patents and copyrights, as I mentioned earlier. The consequence of that, unfortunately, is that anything above 10% return of the value of your tangible assets will be included in GILTI. So to give you a specific example, let's say I have a business outside the US, I'm a US citizen, I am a sole proprietor, so I own 100% of the shares of my foreign corporation, and let's say I have $1 million worth of factory equipment, vehicles, computers, desks, and things of that nature. Well, that means that I'll be able to claim that $100,000 of the CFC's income is essentially attributable to return on those tangible assets, meaning that $100,000 is safe of US taxation. However, any revenue above $100,000 would automatically trigger a GILTI inclusion, which is not very fun for American citizens who are genuinely running a business overseas. Now, Are there ways to avoid GILTI? The answer is technically yes. However, it is much more difficult than in the case of Subpart F. So for example, both Subpart F and GILTI have this thing called the high tax exemption, which is basically translates into if the foreign corporation is already paying tax at a rate of at least 90% of what the US rate is, then it can exclude the income from both GILTI and Subpart F. So at the time of filming this video, the US corporate rate is 21%, meaning that if you have a foreign corporation taxed at 18.9%, give or take or more, you should be good. So some Americans have said, well, 18.9%, that's already some tax savings there, and I can live with that. Sure, that can work. It's not tremendously advantageous, but at least some tax savings. In addition to that, obviously another business strategy could be to simply increase the amount of tangible assets in the business and therefore make the value of that 10% return greater. And the last technique that can be potentially used to minimize GILTI exposure is to include a US holding company into your global strategy. So sometimes what we do for our US clients who do not wish to renounce US citizenship is we advise them to set up a US holding company, which can be either a C corporation or an LLC with a C corp election. And we put the shares of the foreign corporation into the US holding corp. Why? Because US holding corporations that are obviously taxed as C corps, they have the advantage of excluding 50% of GILTI income from taxation, meaning that out of, $1 million of GILTI income, you will only pay tax on $500,000, which effectively reduces the rate of tax in the United States to around 10.5%, give or take. And then there are some strategies where you can, as a US citizen, then take out qualified dividends from your holding corp and pay either, 0, 15, or 20% on those. So, it can be interesting. You're obviously not hitting zero, but you're optimizing as much as possible. In addition to that, US holding corporations can also claim a tax credit for up to 80% of taxes paid in the foreign jurisdiction. So that is also an advantage that is available to corporations and not available to individuals. There is also an option, just to mention it very briefly, I'm not going to go into those details, where an individual can choose to be taxed as a corporation, but that is very rare, and therefore I won't really touch upon that on this video. So there you have it. Those were two general overviews of both GILTI and Subpart F. Do take into consideration that in both cases there are far many more details and far many more little rules and exceptions and regulations that we can look into for each individual case. So if you want to learn more about Subpart F and GILTI and want to know if there's maybe an additional small exception that applies to your very specific case that was not broad enough to be mentioned in one of these videos, then feel free to like this video, subscribe to our YouTube channel, follow us on Instagram, and go to our website. Consider becoming our client so we can best serve you. We can talk about Subpart F, about GILTI, about many other alternatives, and help you go where you're treated best.